Veterans are upside down on their house and no one is warning them. If you're a veteran getting ready to buy a home in 2025, there's one cost inside the VA loan that can either protect your BH or blindside you. Not because the VA loan is flawed, it's actually the strongest benefit we've earned. But if you don't understand how it works in today's market, then you risk making decisions that cost you tens of thousands over the next decade. I'm Joe Nelson with the Nelson Home Group, 21-year Air Force veteran, KC local for life, and my mission is simple: protect your dollars, your entitlement, and your financial future. If you want clarity instead of confusion, stick with me, and if you ever need real guidance, my team and I are just a call or text away. The VA funding fee is quietly putting veterans upside down in their home and setting them up for failure. So what is the VA funding fee and why do we have it? First, the funding fee is not a penalty. It's what keeps the VA loan program alive. It is a cost that gets added to your loan amount. If you buy a home with a VA loan and you put zero down, you're upside down on the house the day that you take possession. So why do we even have it? When a veteran defaults, the VA steps in and covers 25% of that loan for the lender. That guarantee is the reason we get zero down, no PMI, favorable rates, and protections other buyers never see. When you understand that, it becomes less of a con and more of a system that protects every veteran behind you. And if you need help running the numbers for your situation, reach out to me or anyone on my team and we'll break it down for you in plain English. Let's strip out the confusion. Here's what the VA funding fee actually costs. If you're a first-time VA buyer, the fee is typically 2.15%. On a $350,000 home, a very normal price point in our market around Kansas City, that's $7,525 rolled into the loan. And if you've used the VA loan before, it bumps to 3.3% or $11,500. It is not paid at closing, it is tacked onto the loan. This comes with its own set of pros and cons though. The downside, you are upside down on your house for the first few years and you owe more than it's worth. If you must sell or move, you could be screwed. On the bright side, since you didn't write that check up front, you keep your cash available for PCS emergencies, temporary lodging, or life happening at the worst possible moment. Keeping money in the bank is a strategy, not a disadvantage. And my team walks veterans through that strategy every single day. This is just something I want you to be aware of and plan for. We close loans with VA funding fees every week. How can you avoid thousands and extra VA funding fee costs? Here's the good news. If you have a 10% VA disability rating or higher, your VA funding fee is waived for life. Not once, not sometimes, every single time you use your VA entitlement. On top of that, VA disability income is tax-free and can be grossed up most of the time for qualifying, meaning we're allowed to count it higher on paper by adding an extra 25% to your pay. That increases buying power while keeping your monthly payment manageable. For many of the veterans we serve, this is the difference between settling and landing in a neighborhood that actually fits their lifestyle and commute. If you're unsure whether your rating qualifies or how this plays into your numbers, the Nelson Home Group will walk you through it. We have no pressures, just answers. How do you avoid potential foreclosure on your VA loan? Even without a disability rating, you still have levers you can pull to control the VA funding fee and, more importantly, protect yourself from being upside down. Putting money down isn't about beating the system, it's about risk management. 5% down payment drops that funding fee to 1.5%. 10% down drops it to 1.25%. But the real win is this: you start with equity instead of hoping appreciation bails you out. If you're not 100% sure you'll be in the home long term, job changes, PCS, life happens, a small down payment can keep you flexible and protect you on resale. Zero down is an incredible benefit, but it's not automatically the smartest move in every situation. This is where strategy matters. We'll run the numbers both ways so you can choose the option that protects your exit, not just your payment. There's a rumor online that the VA loan is more expensive than FHA or conventional. Let's shut that down. Some financial influencers still claim the VA loan has higher fees. With respect, that's just not accurate. FHA loans require upfront mortgage insurance and monthly mortgage insurance. Conventional loans with less than 20% down come with PMI and often higher interest rates. VA loans offer zero PMI, zero down, and historically lower rates, even in today's environment. When someone tells you the VA loan is more expensive, what they're really telling you is they don't understand the benefit. Don't let that misinformation cost you money. If you want a side-by-side breakdown, call me directly. I'll show you the numbers. Before you make your next move, get real guidance. Speak with a professional. Feel free to call me. Your VA loan is one of the most powerful benefits you've earned with your service, your sacrifice, and every year you spent putting your life on hold so others didn't have to. Don't navigate this alone. If you're buying in Kansas City, relocating here, or PCSing in 2025, call or text me. My team and I will walk you through your numbers, your timing, your entitlement, and your best strategy. No pressure, just a real veteran to veteran advice. And if you found this helpful, consider liking the video and subscribing so you never miss the intel that protects your family's financial future.